Good evening and welcome to the India development debate right here on ET Now. The fault lines in the economy are only getting deeper. The RBI's Monetary Policy Committee, or the MPC, has begun a three-day meeting ahead of the big announcement on Wednesday, and all indications are that it could vote for a hike in benchmark interest rates. For one, consumer inflation is well above the central bank's comfort levels, and the high fuel prices could only make things worse. Petroleum Minister Dharmendra Pradhan has virtually ruled out any big reduction in the excise duty to soften that blow, blaming the high currency volatility for the spike in petrol and also diesel prices.
Government sources admit that an interest rate hike could be around the bend as the RBI looks to keep inflation under check. And despite the windfall gains from high petroleum taxes, government finances look weak, even raising the prospect of fiscal slippage. At a time when growth is slowly picking up pace, an interest rate hike could spoil the party, while any giveaway on the fiscal front could come at the cost of foreign inflows as well. Add to that the rising cost of government borrowing. The signs are ominous. The fault lines in the economy and what it means to the government, the economy and the market at large. That's a topic of discussion tonight on the second edition of the India Development Debate. Joining us on the show this evening, we've got Anand Narayan, money market expert and professor at the SPJ Institute, V. Anantanageshwaran, independent consultant, Vansite Consulting, D.K. Joshi, director and chief economist at CRISIL, and Maithili Busturmat, consulting editor of ET Now. Anand Nageshwaran, let me start off with you. The MPC meet begins today. Is hardening of interest rates now inevitable given the inflation trajectory and higher oil prices? Also, on hindsight, do you believe the MPC was right in not cutting rates when there was this overwhelming clamour, because that would have fueled inflation even further perhaps?
No, I think you're right that the MPC was right in not cutting interest rates, because lower interest rates were not the answer to the investment revival in India. At the same time, I think right now, if the MPC were to take a stance of not raising interest rates, that wouldn't be a wrong decision either. So yes, I think the inflation pressures are there. We are already at 4.6%. Your target is 4%. But there may be a case for trying to see through the current spike in the run-up in the oil price and wait for firmer evidence of pass-through effects onto the overall price level in the country. I'm saying this because I think the overall macro parameters, although at some levels they may be improving, they are still quite fragile. And you look at industrial production, core industries, even the PMI numbers for the month of May, which were released in early June, etc. I think all those things are not really pointing to a robust recovery. Underlying demand conditions are weak overall. So I would say they were right not to cut interest rates, but that doesn't necessarily mean that they need to establish credibility at all costs by raising interest rates now, because sometimes it could also be interpreted as a sign of desperation.
Okay, just hold your thoughts there, because I want to take this across to personalities. I mean, how is this rate cycle going to be determined? And Anant Narayan, I'm going to come to you. Governor Patel had stuck to a neutral stance in April, and he was in favor of, quote-unquote, waiting for more data and watching various risks to inflation. Retail inflation in April accelerated to 4.64. Core inflation increased to 5.9, and for the sixth month it kept increasing to touch a 4-year high. Along with this, rising crude oil prices, a depreciating rupee which has weakened 3.36% since the last policy, and of course good growth numbers for the fourth quarter at 7.7%. Is this the data that he needs to act on rates, or do you believe the MPC may choose to wait for clarity on MSP, on monsoon and further oil price movement? Could this entail a pause on rates but a chance to hawkish? I mean, what makes sense now?
You're absolutely right, Supriya. I think the casting vote clearly will be that of Governor Patel. We pretty much know where the other two members of RBI are going to be, and possibly the call will be on Dr. Patel on whether to pull the trigger or not. Look, at one level, the market has already done the job for the RBI. You know, 5-year bond rates and 10-year bond rates are currently at 7.85%. They've risen by over 110 basis points over the last 9 months or so. Likewise, CD rates, CP rates, borrowing rates, and now even MCLR rates are starting to go up. So even without any policy action, the market has moved into a trajectory of much firmer rates than before. So in a sense, the RBI can afford to not raise rates right now because the market has already factored and done the heavy lifting for it. Having said that, from a credibility perspective, given the overall context to all the factors that you mentioned, plus the fact that our twin deficits are starting to rear up again, and the global context is as uncertain as it is between geopolitics and what's happening in the US growth and the Fed and Dr. Patel's article in FT today. Given that entire context, I think RBI will be well served to actually deliver a hike and go into a tightening mode right now. Otherwise, you would risk being called out as being behind the curve. And we all have memories of what happened in 2011 and 12 when the RBI was panned for being behind the curve and ignoring the signs on the twin deficits for a long, long time. Unfortunately, both on the fiscal front and the FX front, we are seeing incipient signs of strain and of unsustainable kind of deficits being built up. And I think it's important for the RBI to take cognizance of that.
Do you agree with Anant? I mean, can Governor Patel afford to be behind the curve on this one, given what's at stake and given the macroeconomic context right now?
Well, I don't think so at all, because the RBI has been behind the curve. In fact, in the past, when the inflation rates were coming down, that time the RBI did not cut. It was already behind the curve then. So now, particularly since it is supposed to be an inflation targeter as it were, it cannot afford to be behind the curve. Moreover, monetary policy formulation is always a question of a balance of risks. So if you look at the balance of risks, then certainly the risk is that of higher inflation, and growth seems to have more or less kind of grown some feet as it were. So I think that right at this particular juncture, especially since monetary policy has to be forward looking, you cannot wait until you get 100% vision. 2020 vision is possible only for commentators like us who have the advantage of hindsight. But for the Monetary Policy Committee, which has to act in advance, you have to just basically weigh the balance of risks. And here I would agree with Anand, the balance of risks is certainly shifted. In fact, now RBI does need to hike rates, not only because it will otherwise appear very foolish, if I may use a slightly harsh word, but also because all over the world you can see evidence that the easy liquidity of the past is over. The Fed is almost certain to hike rates, and the RBI cannot afford to lag behind. It must hike rates right now, because by August it might be too late.
All right. Mr. Joshi, let me come to you. High crude, weak fisc and shaky CAD. There seems to be consensus now that interest rates in India are perhaps headed higher. How must the economy brace up for the tighter monetary regime, and how will this really impact already anemic fresh investment and also nascent growth? There are obvious side effects to this high rate, but does it all depend on the quantum? And the larger question is, will 25 basis points really make a big difference at all?
Well, I don't think in the current context 25 basis point will make any difference. I mean, because as was pointed out earlier, there's already de facto tightening in the economy. I think the interest rates, whether it is a risk-free rate, the government bonds or the corporate bonds, or even the bank deposit, and I think slowly the lending rates will also perk up, because the MCLR, at least 6 to 7 banks have raised that. So clearly, I think we are in a upcycle. Whether central bank will decide to raise rates on the 6th, or they'll hold on, I think it's a very close call. I mean, if they want to be certain of the growth trajectory, I think they might like to wait for some more time. Otherwise, I think the conditions are getting ripe for a rate hike. Now, as far as the economy is concerned, I think most of the issues in the economy are structural in nature, and I think interest rates can do very little to perk the economy up, I mean, in such a scenario. And I think I think the global environment is quite volatile, so to say. The macros need to be in good shape. I mean, whether it is the fiscal deficit or it is the current account deficit is, of course, I think not in our control, because we run a non-trade deficit or non-oil trade deficit, as well as I think the trade deficit on the oil front is also picking up directly. I mean, there's the impact on fiscal deficit and inflation is a little muted, but on the current account deficit, which is a key parameter for foreign investors, I think it's immediate. So I think there's need to veer towards prudence right now, and I think even if you are on the side of caution in doing that.
Okay, you're saying there's case to err, perhaps on the side of caution. We need prudence right now. But Anand Nageshwaran, to pick up on the point that you were making earlier and to take that comment forward from Mr. D.K. Joshi, gross fixed capital formation, indicator for investment in Q4 FY18 grew at 14.4%. That's the highest that we've seen in 7 quarters. Now, I know you said just a little while ago that you don't believe that interest rates have an impact on investment, but how big a jolt could these high rates be to the nascent recovery? Because it's not just about a 25 basis point rate hike. It's also, like Maitri pointed out, signaling a reversal in monetary policy stance.
No, I think if the underlying demand conditions are indeed picking up quite well, then a central bank hiking rates by 25 basis points will not make a big impact on capital formation. That's fine. But then I even question the capital formation numbers. I think that is not at all computed properly in my opinion, and it doesn't jive with many other indicators. In fact, the gross fixed capital formation in the non-financial sector, I have written in Mint about a month ago that it is actually a fairly garbage sort of an indicator. It doesn't square at all with many other indicators of credit growth or with the RBI data on grassroots bottom-up capital expenditure plans, which they publish every September. There is no matching at all with this. So I don't even believe that the gross capital formation in the country in the non-financial sector, non-financial private sector is indeed picking up. So I think that is not the real issue here. RBI may have boxed itself into a corner in raising rates, given the slightly panicky hints that they have given in hiking the FPI limits on the bonds, corporate and government bonds. And then today's FT article by the governor itself could be interpreted by the market, by some participants, as some sort of a sign of desperation about dollar liquidity, particularly for India. So in that sense, maybe they have boxed themselves into a corner. If they don't raise rates, they risk losing credibility. But this would be a problem of their own making. They could afford to talk policy in this meeting and hike rates in the next meeting, but probably they have not left themselves with too much of wiggle room in that regard. Personally, I would actually take a prudent wait and watch call rather than a hike action in this meeting.
Okay, let me just take this across to Anant Narayan there, and I just don't want to box ourselves. While the RBI may have boxed itself into this rate hike, but I don't think we need to box ourselves just into the policy commentary there. Let's just talk about the larger state of the economy picture, because New Delhi seems to be also coming to terms with the fact that rates could be going higher and RBI may have not been left with the choice. We know that the government will boast of growth numbers of 7.7% for the last quarter of last fiscal, but both you and I, Anant, know that it was due to government spending and a higher base effect. The real threat now to the economy is oil prices. What sort of a risk do you believe that poses for the economy, for growth at large?
The signs aren't great, Supriya. So look, there are two issues which bother me at this moment. And one is the external balance and the other is the internal fiscal balance. On the external balance, I think our current account deficit clearly is on an upward trajectory, which is not good. From $15 billion in FY17, it went up to $50 billion. And it was not all oil. It was also imports of electronics, it was also import of gold, and it was also very, very tepid export performance. Something is going wrong with our exports, and I hope it's temporary. Now, and that number of $50 billion could easily go to 65, 70 this particular year. The other thing which is happening alongside that is our net FDI actually is coming off. For the first 11 months of FY18, it's down by about $6 billion from the previous year. And now that means that actually now we are funding our overall growing current account deficit by borrowing money. Now, and we are not borrowing high quality money like FDI, which will lead to investment and therefore becomes in some way self-sustaining. We're actually hiking interest rates and hoping to get in carry flows to pay for our oil bill today. That's not a very sustainable model. And you're right, I think now on the external sector, it's possible that North Block and Delhi is reconciled to higher interest rates in India as a way of ensuring dollar rupee doesn't rear up again, go towards 70 and increase the burden on the voter in this election year. So that's going to be a problem as well. But I do think the FX issue is larger. There is an imbalance. We have a growing current account deficit. I think rupee could be weaker and to try and reduce the current account deficit, increase exports and reduce imports. And I think we could have a better balance achieved rather than having to raise money by raising interest rates. On the fiscal side as well, I think there's a problem. Yes, the headlines look good. We've brought down fiscal deficit from 4.5% in FY14 to 3.5% in FY18. But as you pointed out, almost all of it and more has come from the oil bonanza. What used to be excise minus of subsidies of 0.2% of GDP is now 1.2% of GDP. Plus you have increase in customs, you have dividends from the oil companies, you have taxes paid by the oil companies, and you have VAT for state governments. Both state and center are making a bonanza on the fiscal side from oil companies compared to FY13-14. Now, if oil prices start to go up, and today it's already up by 30% over last year in rupee terms, that fiscal bonanza is going to go away, and that will leave a very, very poor edifice on the fiscal front. Already our revenue deficit has been growing up. In FY18, it's up to 2.6% from 2% in FY17. So the quality of the fisc and the quality of the external sector both are looking very suspect. It's no way comparable to the times of 2013 as yet, but these are early signs of worry, and we have to be vigilant. I just wish we had a weaker rupee and a better balance on the external and on the internal front.
Well, okay, but comment on that. On the point of the fiscal deficit, like Anand pointed out, it's improved from 4.5% of the GDP in FY14 to 3.5% in FY18, budgeted at 3.3% for FY19. But much of that was in the back of the increased oil revenues, as Anand pointed out. In FY14, for instance, like Anand pointed out, the centre's net revenue across excise and subsidies was what, 0.2% of GDP, which has become 1.2%. But rising crude has put this fiscal bounty under threat. Is it now certain that meeting 3.3% fiscal deficit target will be extremely challenging, even though the government has resisted the temptation to reduce excise duty on petroleum products?
It's very difficult to say, Sandeep, right now, because we're pretty early into the current fiscal year. So things can change, because given the agreement between Saudi Arabia and Russia, one really doesn't know whether oil supplies will ease up, which of course will be a big, big blessing for us. But I would disagree with Anant in saying that earlier when we talked about the twin deficits, yes, on the external front, I think I would agree with him. We have much more reason to worry. But on the fiscal front, I'm less worried, for the simple reason that the government was fairly wise in using the windfall, quote unquote, from lower oil prices to continue spending at a time when the private sector was not spending. So because the government was spending, particularly in one particular sector, that is the road sector, the government used that money to create infrastructure, and this is the kind of government spending which will hopefully crowd in private investment. Because remember, whenever we talk about government and fiscal deficit, there are two kinds of impacts that it has. One is where it crowds out, and the other is where it crowds in. To the extent that this particular government has spent on a lot of essential infrastructure expenditure, the hope is that private sector investment will subsequently flow, because you're making it an enabler. So to that extent, I'm a little less worried about the fiscal deficit. Yes, of course, once oil prices rise, we will not get that benefit. But if you've created a solid foundation, and I would say we have created some kind of a foundation, and in fact, the worry right now is not so much about the union's finances, but more about the state's finances. And if you look at the overall picture, yes, it is not too good. But as far as the union itself is concerned, they have shown a remarkable amount of fiscal prudence, and so I'm less worried about the fisc at the moment. Of course, if oil prices continue to rise, then it is under serious danger, for the simple reason that as election approaches, it's going to be very, very difficult for any government to retain that strong, bold face and say we will continue to pass on the price of higher oil in the form of higher oil prices to the domestic consumers.
Absolutely. Maithili, that's exactly the point, no? Yes, that's exactly the point, that the government has been very brave to pass on fuel, but will it keep up the bravado in an election year is really the big question. It will be difficult if crude continues to rise. Mr. Joshi, is it a given then that the new formula for oil price which is being talked about will mean partial deregulation, where the burden of high oil price will be shared both by exploration and retail oil firms?
Well, I think what government typically does is, I think it diversifies the burden of rising global crude prices. I think, and there are three agents that share it. One is the households, the second is the oil companies, and the third is the government itself. I mean, if, for instance, government reduces the excise duty, which it should, I mean, because otherwise there's an asymmetry. I mean, when the oil prices are falling, they raise the taxes, and I think so the taxes are supposed to come down when the oil prices started rising, I mean, to smoothen the impact. So that's why we are seeing an asymmetric impact of government's action. And the third, I think my sense is that the burden of global crude price increase will be felt by all the three actors. Right now, I think it is being felt more by the households, and I think it will slowly shift towards oil companies and also towards government if the oil prices continue to be on the boil.
Anand, you spoke about the currency and want to bring you in, Anand Narayan, that is, the currency is weakened, rupee is weakened 5% against the dollar in 2018. Is there more weakness expected, especially if crude continues to rise? What is your own outlook on the rupee, which is a key cause of concern?
Sandeep, look, we have to understand that in the current context, both RBI and the government have plenty of tools available for them to control volatility in the rupee market. Let's not forget, RBI still has a vast amount of FX reserves which they can use, and they have used the last 2 months. And plus, of course, monetary policy, if it were to tighten, that's one way of ensuring that the rupee remains strong. I suspect, and I don't know for sure, obviously, but I suspect that North Bloc is okay with higher rates, as you mentioned, as a means of keeping rupee under check and ensuring that a combination of higher dollar rupee and higher crude prices doesn't add to the household burden for now. So I suspect for now, we're going to keep rupee under check, and monetary policy might have a role to play in that context, especially if the RBI decides to go the hiking way as well. Having said that, as I said earlier, the balance isn't looking great. We can always buy time for the short run. Hiking rates will get in FI flows, hopefully, or at least stem the outflows and keep things on an even keel while RBI uses reserves.
Right.
But I do think there's an imbalance because we are funding the oil bill currently by borrowing money, and that has to adjust somewhere.
Yes, yes. I'll take a quick question to Anant Nageshwaran, and this one is on the current account deficit, which seems to be this big concern on the horizon, Anant. CAD has moved up sharply from $15 billion in fiscal year 17 to about $48 billion in fiscal year 18, which is the worst in 5 years, and it could go up, like some experts point out there, to $65 billion this fiscal. This can't all be on account of just oil prices, like Anant was pointing out earlier. Exports continue to disappoint us, and we continue to import gold.
Yeah, I think you're right. This is a long-term structural problem. In fact, the export boom of 2003 to 7 was driven by special factors, including an extraordinary global boom and credit availability, etc., when rising tide lifted all boats, including India's exports. But we really have a problem of efficiency, scale, and global standards. And that, in fact, tells us that the underlying economic structure is still very fragile. And in fact, if you really want to keep an eye on the fisc and on the inflation and on the current account deficit, the best thing will be for this government to let the market oil price pass through to the consumer, even if there is going to be a bit of a hit on economic growth. Because by not passing it on and trying to keep the consumer spending going and consumers happy, that would actually be inflationary. So between the North Bloc and Mumbai, I would simply say, let the oil price pass through. It will be a demand restraining effect. It won't hurt the fisc. It will dampen growth because of the impact on consumers' wallets. And RBI on its part should be able to see through the inflationary impact unless it spills over in the second round to a generalized price increase. So this is the better coordinated strategy that addresses many imbalances: fiscal, current account, inflation, and at the cost of some growth. But it will preserve the overall macroeconomic stability rather than trying to cut the duties and keep the price low, because it would temporarily help inflation, but it would actually add to demand and add to current account deficit, etc.
Okay, that's an important point, a contrarian view on why the government should not bring down duties and just do a complete pass-through when it comes to the fuel prices, to crude prices on the consumer. Maitli, quick last word from you. There's obvious political cost of a rate hike, but for a government that's going into elections, what will matter more, reining in inflation or trying to boost private investments?
Oh, well, certainly it is inflation, because inflation in a country like India, it hits the poor most of all. And typically, given the way our inflation index is constructed, it hits the poor in their stomach, because this is food prices that contribute to a major part of the basket, which gives us our inflation number. So certainly any government hoping to win an election will focus on inflation and not bother so much about investment, and hopefully investment is picking up.
All right. On that note, thank you very much for joining us. It's quite clear which way this decision will go, because the stage is set for the Monetary Policy Committee to decide the trajectory of interest rates in India. It's a decision that will decide your EMIs. It will be a tough call between reining in inflation and not being a hawk. But high crude prices and high inflation have perhaps tilted the decision in favor of a rate hike.
Completely timed out in this edition of India Development Debate. Thanks for being with us. Up next is news and updates. We've got India Tonight up next at 8 o'clock. Keep it with ET now.